In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Good afternoon once again, Market Rebels. And yes, this time it is the afternoon, but it's a day early. So it's Wednesday. Normally this is going to be broadcast at Thursday at 4 p.m., but it's Wednesday at 4 p.m. So the good news is we just had our Fed announcement today that we've been on pins and needles for. How do we end up wrapping up here today, Stu? Not a whole lot of action.
Kind of unchanged, man.
A little bit, yeah.
You know,
kind of what did the Fed watch tool? I think they were looking for what, a 96% chance to lose.
96 and I think 0.8.
Yeah, almost 97% chance to be unchanged. So not a big unexpected event here, but still a lot of things kind of selling off here slightly as we go into the close.
Yeah.
But anyway, for today, again, we had to record early, but we'll have to see how things shake out tomorrow. Tomorrow's another day. But last week we called it a covered call mystery, I think was our title. And we were talking about how when a lot of new traders sell a call, let's say they get $300, they're going, where's the $300? My account value, the total value stayed the same, or in some cases went down.
Just like that old commercial, like, where's the beef?
Exactly. Where's the beef? Where's my cash? So it's a very good question. We get that a lot in Q&A. So we thought that would help some of the people out there on YouTube and people who might be new to or even experienced with options. It's a very tricky question. But today, since we were doing covered calls last week, I thought, you know what? Let's do another topic that I like, a new look at covered calls. I know a lot of times people think that covered calls are an entry-level strategy because they already had stock. They can sell calls. They can get cash. I'm willing to sell my shares anyway. What could be easier? And they think it's a very basic strategy.
Yeah, and you know what? That's tragic because it's not.
It's not.
And there's a lot of hidden holes and dangers to it. And on the plus side, you know, this inference of like push button get money is just ridiculous.
That's what we talked about last week. And synthetically, it's the same as a short put, naked put. So think about it. The irony there, your broker will most likely let you do a covered call with the lowest level of an approval rating. Your brokers always have different approval ratings. They might go 0 to 3, 1 to 5, but they're going to have some scale that says at this level, we will allow you to do this, and this strategies. But if you want to do spreads, we're going to require level 2. If you want to do nakeds, you have to have a different level. And most brokers will allow a covered call at the very bottom of the ladder. But to do a naked put, it will always be at the very top of the ladder. And as Stu said, they're mathematically the same thing.
Mathematically exactly the same risk.
So if you think you can't get hurt on a covered call, you are fooling yourself. You have to understand the ins and outs about how these things work.
Mm-hmm.
So today I thought very cool topic. Let's talk about a new look at covered calls. And what I mean by that, it's a different perspective from what most traders are taught. And as we find out, it's a pretty good way to approach it. So let's start off with a quick reminder of what a covered call is. This is where you're going to buy shares of stock, or perhaps you already own them. And then you will sell calls in a 1-to-1 ratio. So if you have 100 shares in your account, you could sell one call. If you have 300 shares in your account, you could sell 3 calls. And as I mentioned last week, you wouldn't have to always completely cover the calls. If you had 300 shares, you could maybe sell 1 or 2, but you wouldn't want to sell more than 3.
Well, you could, but then it really wouldn't be
Well,
covered.
you could, but then it's going to put you into naked position. Exactly right. So the benefit is, the thing that everybody has their eye on is that by selling the calls, you get cash. And as we found out last week, it's not immediate cash like everybody thinks. We have to wait for it to accrue over time to kind of, it's usually called unrealized revenue once you receive that cash. But the bigger thing is that people forget about is they have the obligation to sell the shares for that strike, no matter how high that stock price goes.
Bill, you're
Right, so
not going to
that's
believe this. Meta is up 10%.
right now,
Yeah, on earnings.
unbelievable.
Microsoft is up $35 on 500. Oh my God, what is going on?
Wow. Well, that should hopefully
Ow.
light a fire under things tomorrow for some of the
Yeah,
tech.
yeah, yeah.
Oh, that's
Seven.
cool. So let's
Yeah.
take a different approach to the covered call. So that's our basic definition. Before we do, quick reminder for everyone, please check us out, marketrebellion.com/get started. We have a whole host of articles, videos on topics very much like this to help you make better decisions. And as we say every single week, we can't emphasize it enough. It's very easy in the options market to think that you understand how it works. Oh, I think the stock is going up. Let me buy a call. It's not true, or at least not necessarily true. We have to consider direction, magnitude, and speed. There's a lot of moving parts with options that are not there with stock. So if you've come from a stock trading background, which is most likely the case, you want to check this out, especially if you're doing more than paper money or with any kind of serious money. All right, so lots of free stuff there. So let's start off with the square root pricing rule, because this is what sets off, and I don't want to call it a mistake, but it sets off a misperception for a lot of traders. So the square root pricing rule is something that most traders know about. And what it says is it takes 4 times the amount of time to double an option's price. And of course, this applies only for at the monies. At the money, roughly speaking, is where the strike price equals the current stock price.
Roughly.
Roughly, I think we've talked about that
You
before.
just went over that, yeah, a couple weeks
Different
ago.
types of at the monies, but just for right now, that's a good enough definition.
Yeah.
And so the reason for this kind of odd pricing relationship is that option prices are proportional to volatility, and volatility is proportional to the square root of time. So that's where that's coming from. So as an example, one of my favorite examples that I show in all of our Q&A classes, if you have a 1-month option, we look on our broker's platform and it's trading for $1. And then as a professional trader, we might say, what do you suppose the 4-month option is trading for? Well, rather than having to go and check it out, professional traders would have a pretty good handle on it. And here's how they're going to do it. Now, the amateurs are going to think it's going to trade for 4 because it has 4 times the amount of time. But remember, it's a square root pricing rule. And so here's the way that it works. We're going to look at the difference between, or not the difference, but divide them out. So 4 divided by 1 is 4. We have 4 times the amount of time on the second option. All right, so we know there's 4 times. We take the square root of that, and that comes up to 2. That is the key right there. So this 2 right here is telling us what the multiplier is on this side. So now we're trying to figure out, what is this second option worth? Well, it's 2 times the value of the first. But notice it's not 2 times because there's 4 times the time. It's because the square root of 4 is 2. Right? So don't make that mistake and say there's got to be 4 times the price. It is not. It's 2 times. So this 4-month option should be trading for about 2. I say should be because in the real world, we can get skews. This would potentially lead us into a calendar spread, might be a reason why we would take it. But that 4-month option should be trading for 2. What if this were trading for 3? Well, the 4-month option should trade for 2 times that or 6. All right, so pick any pair of options that have 4 times the amount of time. You're going to get that kind of relationship. Let's try a different one. We have a 3-month option. We look at our broker's platform, it's trading for 5. What do you suppose a 27-month option is trading for? Well, take a look. 27 divided by 3 is how much? We look at that ratio, and that is 9. We take the square root of 9, which is 3. Right? So if you don't know about square roots, just punch that into your calculator. Square root of 9 is 3. All it says is that that number times itself gives us that number. So 3 times 3 is 9. So the square root of 9 is 3. And that tells us that over here, that the second option should trade for about 3 times the value of this one, even though we have 9 times the amount of time. So this option we would expect to trade for $15. So this gives us kind of an interesting pricing relationship that we can use strategically. So in the financial markets, remember that time equals risk. And longer dated options are cheaper per unit of time. And that's partly because there is more risk. Shorter dated options are more expensive per unit of time. So for instance, we saw that the 1-month option is trading for $1, the 4-month option is trading for 2. Well, this first option right here, if you were to sell it, is what? $1 per month. But if you sold this 4-month option for 2, yes, you're getting twice the dollars, but you're only getting 50 cents per month. And so this is where a lot of traders, and again, I'm not going to call it a mistake, but it's a different perspective. They'll say, oh, I should always be selling this one because I'm collecting more money per month.
Well, it kind of is a mistake because they're not really thinking about this relationship.
Yeah.
They're just, kind of like regurgitating, well, I should sell short-term options because over time I can get more money.
I can get more money.
Leaving it at that. But that, that's like 1/10 the story. You got to think the whole thing through here.
Yep. So let's look at, again, this idea of cost per unit of time. So it's a little bit like buying things in bulk. So you might be walking through a store, you see a single can of Coke, let's say, is selling for $1, but you might see 6 that might be selling for 3. Now, to the shoppers, everybody knows that you shouldn't look and say, oh, these are 3 times as much, right? We know better than that. Why? Because you're not comparing apples to apples. You're comparing 1 can to 6. So if we look at this per unit of, let's say, per can or per ounce, we're going to put them on some kind of a standard scale, that this one is costing $1 per can. What's this guy costing down here? 6 cans for $3 is 50 cents per can. So they're actually cheaper per unit of time. And so that's what makes people realize that as if I'm going to be a covered call seller, I should be selling shorter dated options because I'm getting more money per unit of time. So even though it looks like it's 3 times as much, right? $3 is 3 times as much as $1. We should really look at that and say, they're really half as much. This one up here is $1 per can. This is 50 cents per can. So it's like buying things at Costco. Yes, it's going to cost you more when you check out, but when you divide that out by the number of units, it's a whole lot less. So here's the way that most traders approach covered calls, is that they want to maximize profits. And hey, who doesn't? All right, so they say, okay, my goal is to maximize profits, and therefore I should sell shorter dated options. So in other words, maybe I should sell 4 weekly options instead of 1 monthly. Why? Because I'm going to get more money. Like we just saw, if the 1-week option is trading for $1, or the 1-month option, the 4-month option is trading for what? 2. So if I can sell that 1-month option 4 times, I can get $4 instead of 2. And that's the perspective. Again, we're not saying it's wrong, but that's the perspective that most traders approach this by, and one of the reasons that they end up getting hurt with a covered call. So the first thing we want to pose to everybody is maximizing profits always the goal? Couldn't it sometimes be about risk?
Protection.
Exactly. If your goal is to make X percent, let's say 10% per year, and this strategy is potentially providing 50% per year, well, yeah, that's maximizing it. It's pushing it to a higher number, but that's probably not what you want because it's coming with higher risk. So remember that we always teach in Q&A that you want to start with a goal. You have to have some kind of a goal, a reason for doing the trades or even investing, because you can't even define risk without having a stated goal. But what's risky for one person might not be for another because of the goals. So let's take a closer look at this idea of a new look at a covered call. So here's shares of stock. So remember, you have to own the shares, or maybe you just bought them. That's your risk graph. Just means that you're making dollar for dollar up. As the stock rises, you're losing dollar for dollar down. That's why it's a straight line. If you do the covered call, let's say if we sell the 105 call, we transfer from the black line to the red. Now remember, we always get a bend at the strike so we can see that we have sold the 105 call. That's flat because remember, we have sold off all rights above 105. No matter how high that stock price goes, we're going to get assigned and we're going to collect 105. So why did we do it? Well, the main reason for doing a covered call is the downside hedge. Notice we have shifted the break-even point on the black line down by the amount of the premium. That is the main reason for doing a covered call, is that it's more of a defensive strategy. And as we've shown in Q&A, what happens in the long run? You underperform the S&P 500 or whatever the stock or the index is. So again, it's not saying it's bad, it's just less risky. Why? Because you're reducing that downside. But now the question is, yes, we are giving up all of this above this red area, this little triangle, but are we ever going to get that? No, that's not, it's far from guaranteed. So what you can do with, if you're new to covered calls, is say, all right, yes, of course it would be nice to get this, but is that really what I'm after? And if it's not, if you're not after it and you're saying, look, this is going to be plenty good to put me on track for my goals, and I can get a downside hedge, then let's do that. Let's not get wowed by saying, well, you know, if I go with a further out of the money option, I can make even more money. You can always push those maximums higher, but that's not necessarily a good thing. We have to consider risk. So what's the big risk here, Stu, that we hear people talk about in Q&A when they sell, let's say, a 3-day option or a 1-day option? I'm sorry, or a 1-week option. What happens? Stock tanks, and they say, now I can't sell calls again.
Yeah, well, that's right.
So the big risk that is overlooked is that you might only get one chance.
Or right, they say, yeah, all right, well, the stock tank, I'll sell calls down here, and then the stock rebounds, and
now
they
you've
say,
locked
oh
yourself into a loss, right?
right, you just like, and they didn't even know what happened, right? Their head's spinning around so much, they had no idea what happened.
So for example, let's say if the stock stays at 100 and we sell this call for $1, which means we can make the $5 capital gain plus $1. That's kind of what it looks like our maximum gain is. Well, if the stock stays here, every single month I can sell this 5-point out of the money option for $1, and I can keep shifting this red line further and further left. That's in an ideal world. But what we're talking about here, you might say, all right, I collected $1 for this option. I have a $99 cost basis, but now the stock is way down here at 70. So if I sell an option that's 5, I'm not going to get anything for the 105 with the stock at 70. So maybe I say, hey, you know what, Stu, I've got a bright idea. Let me sell the 75 call. That's still 5 points out of the money. If I collect another $1, I now have a cost basis of 98. Right? I sold the first one for $1, second one for $1, bought the stock for 100. So now I've got a cost basis of 98, but now I get called out at 70. That's $28 loss. So with the stock down here at 70, I might say, you know what? I can't afford, I don't want to take that risk to sell that 70 call. let me wait for it to come back up here to my cost basis of 99. Well, that might be a year, might be 2 or 3 years. So this whole grand idea and plan that you had of selling this call every single week is immediately shot. And that's something that most covered call traders never, an idea that they never entertain. They just assume that they can continually sell calls. We hear that a lot, don't we, Stu? The stock will tank and they'll say, oh, don't worry about it. Just keep selling calls, keep reducing your cost basis. But as you
People
said, if the stock rebounds, you've locked yourself into a loss.
People get sidetracked by this, thing that
Yep.
they've always read about, sell shorter term
Yep.
and just keep doing it and keep doing it and keep doing it, and you'll make more money. Well, like you say, you may not get that shot.
You might not get that chance. So what can we do instead? This is where our new look at a covered call comes in. Again, quick reminder, marketrebellion.com/get started for more ideas just like this, all for free. So let's take a look. Now, these are some older screenshots, but at the time, Microsoft was trading for 243.30, and this is a 3-day option. And again, this is what most traders would gravitate towards. Why? Because I'm getting more money per unit of time. If I do this 10 times over the course of a month, I'm far better off than having written a 1-month option. And that is true, assuming your plan goes as planned. That's the big if. So let's take a look at the 250 strike. All right, so somebody might say, all right, I've got the stock at 243 and I would have the obligation to sell at 250, but over here, I can get paid $1.74. I can reduce my cost basis by $1.74. Well, how big is $1.74, the premium that we're receiving on a 243.30 cost basis? Well, it's about 0.72%. It's almost 0.75%. Not much, but your return, if exercised, is 3.5%. What does that mean? Well, if we take 243.30 minus $1.74, that's our new cost basis, and then we end up getting assigned at 250, you've made 3.5% on your money. Now, it's not annualized. It's really not a good idea to annualize super small terms like this, but you would make a straight up 3.5% on your money. But notice that most of that is coming from the stock.
The stock, yeah.
It's not, the option didn't really do, I mean, it did something, but it didn't do a lot.
And they're writing home to mom, saying like, look how much money I made from this.
Look how much money I made. Right, it was 0.72%. I don't think anybody gets into this game to earn 0.72%. Now, again, that's not saying it's wrong or that it's bad. We're just saying that option by itself isn't doing a lot for your downside. Why? Because first of all, it's very far out of the money, especially relative to 3 days. So here's what we can do is to come up with a new perspective. Now, again, we're not saying this is the only way to do it. We're saying just consider it. So what if we did this? What if we went out maybe 220 days? We're going to look at the same strike, and we look over here at the mark. Remember, the mark is the kind of the halfway point between the bid and the ask. 23.32. Well, that's a whole lot better than, what was it, $1.74? That's a chunk of money right there. So if you look at that, that's it's almost 10% of the stock. So we've given ourselves almost a 10% downside hedge. Now, granted, it's for 220 days, but if something happens in the next 30 days or 90 days, we've got a really serious downside hedge. Now, if we take the 243.30, subtract off 23.32, in other words, we take this number and annualize it, it's about 16%.
Pretty nice.
That's a very good return. And a lot of people say that's far more than what I'm looking for on the entire portfolio. And if I do get assigned, I'm going to get a bump because the strike is out of the money. That's going to be almost 23%. So now, again, this whole idea of a new perspective is saying, are those numbers good enough for you? 23% return if exercised? Annualized kind of downside hedge, 16%? It's not a bad deal. And most traders would never, ever consider this because they say, oh, I make far more money by selling short term. Not necessarily true. It's extremely risky because you're taking very small premiums, very small downside hedges, and it's going to take one time for that stock to fall 10%, and that whole plan is now wiped out, possibly for quite a while.
Kind of goes back to the idea of you should probably have a goal in mind before you start this exercise.
Absolutely. Makes things a lot easier, doesn't it?
Yeah.
So let's
Tells
look
you.
at the risk graph here. Here was the first one, the 3-day option. And here's the stock. So notice that our break-even point right here, the difference between the gray and the blue line, is right there at 241.56. That's because we sold that call, I think, for $1.74 or whatever it was. It's 1.1% below where the current stock price is. Have we ever seen the stock fall 1.1%, Stu?
Oh,
Yeah, never. That never happens. That happens all the time.
every
In a
day.
single day, you can see 10 or 15. It's rare, but it does happen. And here you are sitting with a little point, what was it, 0.72% of premium based on the option, the stock price. It's not doing a single thing for your downside, and yet that is the primary reason for doing a covered call. But now let's look at the 220-day one. Instead of going to the blue line, look at that. We have a cost base or a break even down here of 29, let's call it 220, 219.98, down 9.5%, almost 10% that stock can fall. And you know what? We walk away unscathed. We've just broken even. That's not a bad downside hedge. And notice that is $21.58 below the hedge of that 3-day option. So again, when you really start looking at the full picture and start incorporating, why am I doing this, and bringing a goal into the picture, does it make sense? Do I really need to make 8,000% on my money because I'm doing these super short-term options over and over and hoping that I can do them every single few days forever? Not going to happen. So again, it's not saying that this is the only way to approach it. It's just to show that options are very versatile and that maybe consider selling something longer dated or mix them up.
Mix
You
them
got
up.
300
Mix them
shares.
up.
Yeah, maybe if you want to sell that 3-day option, but maybe sell 2 of a longer dated.
Yeah.
Or vice versa. Sell one of the longer dated, sell 2 of the shorter dated, but split them
Yeah.
up.
One, and one. Just mix them up.
Mix them up. Lots of things that we can do. But again, what we're trying to really emphasize here is that so many traders hear incorrectly that it's about maximizing, that you're going to make more money by selling the shorter dated. Nothing else exists. You just keep selling those options for 20 and 30 cents. And then one day the stock falls 10%, and that strategy is out the window, possibly for years. Not such a hot strategy anymore. Whereas this one, we can easily live to play another day. All right. So anyway, we hope that gives you, again, a new perspective. And these are a lot of things that we talk about every single week in our Q&A classes. So if you're not part of the Market Rebellion here and our Q&A classes, please join us. We'd love to have you. So with that background here, with our little coach's corner, let's revisit Chalk Talk. For covered calls, is it better to sell many shorter term options or fewer longer dated options? What do we think here? Well, most of you know that our questions are always about, it depends. We can't really say. If your goal is, I want to make the absolute most that I can, and I'm willing to take that risk, yes, sell shorter dated options. But if you can make your goal by selling 3-month options or 6-month options, or maybe even 1-year options, you have to say, why not do it? Give yourself that big downside hedge if that works. So again, it's not saying that it's a mathematical formula that's going to tell you the best. It's just something to consider. It's just a new perspective on covered calls. So I hope that helps. Stu, any closing comments there?
Yeah. So, people have this thing about looking back and saying woulda, shoulda, coulda.
Oh yeah.
You can't beat yourself up on that. You make a decision. People make a decision with all the information that they have, and they do the best they can.
Right.
And then you have to live with that decision, just kind of like in life. The issue here is that people generally do not have all the information that they need to really, assess the upside and the downside, what's involved in this type of strategy, right? You have to look at both sides of it. What am I really trying to gain? What am I really willing to lose? And that's going to help to answer, all of the questions like, which one and how much longer and, when do I roll it and, all that happy stuff. It really just comes down to what are you looking for and what are you trying to do? And, even if you sell that call, you say, all right, I got this 2-month call and I cap my upside at some level, and then the stock happens to run $10 through it or $20 through it, and you're saying, oh, why did I sell that call? Well, go back to why did you sell that call?
That's right.
And the answer is because you're looking for that downside protection, right? You think the answer is because I'm trying to, create
that cash,
sort of
right?
income stream. It might become something you can call income in the future. But in the meantime, it's really there acting as a guard, and it's guarding your downside.
Absolutely. Well said.
So, look, there's lots of stuff you can do with it. You ratio it, you ladder it, different expirations, different strikes. So, it's a good idea to like really kind of get into it and understand the upsides and the downsides and get away from the notion of push button, get money, and that's the end of the game.
And as our friend Steve Levick said, know your risk. Right. It's just know your options and know your risks. And if you do that and you have a goal, a lot of these answers become very obvious. So we hope that helps you, and we'd love to have you join us for our Q&As at Market Rebellion. And until then, we will see you next Thursday, same time on our YouTube channel here for Coach's Corner. We'll see you then.